White. I'll be your timekeeper. I'll give you a 1 minute warning, and as you know, it's a 10-minute presentation followed by a 10-minute Q&A. We've already introduced the judges, so start when you're ready.
Good afternoon, we're the Wofford team, and we are here to present our buy recommendation on Rock-Tenn stock. Our presentation will first provide a description of the company and then a brief analysis of the industry and Rock-Tenn's competitive position within the industry. Next, we will discuss our financial analysis of Rock-Tenn, followed by our valuation methodologies. We will then note the main investment risks associated with an equity investment in Rock-Tenn. 3 critical factors drive our buy recommendation. First, Rock-Tenn has shifted its primary focus from consumer packaging to the more appealing corrugated packaging segment. Second, Rock-Tenn possesses numerous sustainable competitive advantages, including its 19% market share and ownership of a virgin mill system. Third, we expect high EPS growth for the next 3 years.
Rock-Tenn is a leader in recycling and waste solutions and an integrated manufacturer of packaging products. With 86% U.S. sales, Rock-Tenn conducts its business through 3 operating segments: corrugated packaging, which accounts for 66% of external sales, consumer packaging with 27%, and recycling and waste solutions with 7%. Since 2009, acquisitions have increased corrugated's percent of sales from 25% to 66%. Rock-Tenn is integrated at every step of the corrugated production process, with the exception of the manufacture of virgin fiber. However, it does own the mills that process this fiber. The containerboard mills are the key area where consolidation has occurred. With these mills running at over 95% capacity industry-wide, Rock-Tenn has recently been able to implement price increases even in a tough economy.
The top 4 companies' combined corrugated market share has grown from 49% in 2000 to 70% in year 2012. Such consolidation enhances the major players' ability to control prices. Rock-Tenn currently possesses a strong number 2 position with a 19% market share. A moderate level of rivalry, high barriers to entry, and low threat of substitutes encourage investment in the corrugated packaging segment. High barriers to entry include large startup costs, significant economies of scale, high freight costs as a percentage of product price, and environmental regulations. The consumer packaging segment, in contrast, exhibits excessive competition and a high threat of substitutes, which discourage investment and explain Rock-Tenn's strategic shift away from this segment. Rock-Tenn has numerous sustainable competitive advantages. First, its high corrugated market share results in significant economies of scale in this capital-intensive segment. Second, its virgin containerboard mills allows it to produce linerboard and medium at a lower and more predictable cost. Third, being the largest packaging recycler in North America provides Rock-Tenn with recycled fiber at a lower cost. Finally, Rock-Tenn's management has demonstrated its ability to wring out cost reductions and operational improvements. The recent promotion of its CFO, Stephen Voorhees, to COO evidences Rock-Tenn's focus in this area. There are several reasons for investors to prefer Rock-Tenn over its competitors. IP is the only company with a higher corrugated market share. However, IP has far less attractive valuation ratios and a lower concentration of sales in the appealing corrugated segment. Relative to other competitors, Rock-Tenn has more appealing market valuation ratios, significantly greater market share, and thus significantly greater economies of scale. Finally, due to the recent corrugated price increases, all competitors expect strong 2013 EPS growth. However, ongoing improvements in the Smurfit Stone operations should augment Rock-Tenn's EPS growth for the next 3 years.
Tripling its size in May 2011 by acquiring Smurfit Stone, Rock-Tenn took a step backward in order to take 2 steps forward. The acquisition's added debt reduced Rock-Tenn's financial flexibility, and added shares initially diluted EPS. The acquisition's numerous benefits included shifting Rock-Tenn's focus to the corrugated packaging segment, expanding its geographic footprint, giving it ownership of a virgin mill system, and offering the potential of $550 million in operational improvements.
Operating margins in the highly competitive consumer segment have gradually declined, and current year price reductions will continue this negative trend. The mid-year 2011 acquisition of Smurfit Stone's less efficient operations resulted in significant 2011 and 2012 reductions in both corrugated and recycling segments. For the next 3 years, we forecast a rebound in corrugated packaging's operating margin due to both price increases and the realization of Smurfit Stone-related operational improvements. This growing corrugated margin will increase Rock-Tenn's overall operating margin to 11% by 2015. Rock 10's year-to-year core EPS has not been as volatile as its GAAP EPS. Core EPS should more accurately predict Rock 10's future performance as it excludes non-recurring items such as restructuring costs, debt extinguishment losses, and tax credits. To fund the Smurfit Stone acquisition, Rock 10 increased its number of outstanding shares by 79%, which diluted both 2011 and 2012 EPS since the acquisition occurred mid-year. The acquisition's initial profitability was too low to overcome the added shares dilutive effects. However, between 2011 and 2015, we expect a total of $475 million in Smurfit Stone-related operational improvements and synergies to be realized, which will more than offset the added shares dilutive impact. Additionally, we initially estimated that 67% of the 2013 corrugated price increases would stick. Share increases disguise Rock 10's steady growth in core net income from $173 million in 2010 to a projected $609 million in 2015.
We use a weighted average of 3 valuation methods, one involving discounted cash flows with a 65% weighting, and the other 2 involving multiples with a combined 35% weighting. We evaluate 3 scenarios for each method. Our DCF analysis utilizes revenue growth and operating margin projections by segment with key assumptions for capital expenditures and changes in net working capital. Our initial cost of capital increases 180 basis points over the forecast period to reflect currently low interest rates returning to more normal levels. For our multiples analysis, we utilize peer medians, which should be conservative due to Rock 10's strong anticipated 3-year earnings growth. Our 3 scenarios for valuation method include base, optimistic, and pessimistic cases. Our base case assumes 3.5% revenue growth and 49% operating profit growth in 2013 as a result of price increases and ongoing realization of improvements in Smurfit Stone operations. It also assumes an average of 3% ongoing revenue growth and an average of 8% ongoing operating profit growth, again due to realization of operational improvements. Our optimistic and pessimistic cases reflect changes in the realization of operational improvements and growth projections. Overall, our base case assumes a realization of 75% of the remaining $300 million of operational improvements and 67% of the company forecasted $270 million of 2013 corrugated price increases. Despite these changes, our assumptions for our EPS are slightly above that of analyst expectations, which indicate that the market may not be realizing all the changes occurring within Rock 10. All 3 of our valuation methods result in fairly similar weighted average price targets. They result in a weighted average price target of $89, which is a 22% increase over the market price at the time of our initial report.
Of the various risks facing Rock 10, we focus on 2. First, Rock 10's major expenses are all subject to a large degree of price volatility. Volatile expenses include diesel fuel, which impacts Rock 10's freight charges, fiber, both recycled and virgin, and energy, primarily natural gas. A 10% increase in the price of any of these expenses would reduce EPS by 53 to 73 cents. Rock 10's second major risk is an inability to successfully integrate Smurfit Stone and realize the remaining expected operational improvements. Every $15 million of unrealized synergies reduces EPS by 43 cents.
Since our initial buy recommendation, Rock 10 stock prices increased 19%, while the markets increased 3%. Rock 10's first quarter earnings announcement now allows us to price in 100% of the price increases due to realization of 82% of these price increases in the first quarter and the other 18% expected during the second quarter. Due to this one change, we now issue a revised weighted average price target of $103, which is a 19% increase over yesterday's closing price.
In conclusion, 4 main factors drive our price target and buy recommendation. First, Rock 10 is focused in a recently consolidated industry segment that offers its key players significant price control. Second, Rock 10 has several sustainable competitive advantages, including its large corrugated market share, ownership of virgin mills, and extensive recycling operations. Third, we forecast 3-year core EPS growth of 97% and GAAP EPS growth of 156% due to recently implemented price increases and ongoing realization of Smurfit Stone operational activities. Fourth, Rock 10 is the most appealing investment within this industry. Our EPS and cash flow analysis suggests that the market has not yet fully priced these key drivers into the stock price. For these reasons, we recommend Rock 10 stock as a buy.
Questions for me? You ready?
Go ahead.
Okay.
My first question concerns the financial condition of the company. You talked a lot about the acquisition of the Smurfit Stone operations and how that's going to improve their profitability, but they obviously paid for that by issuing stock and taking on additional debt. Would you comment, please, on the condition of their balance sheet, how they're planning to repay that debt, and what that means for cash flow available to shareholders?
I can handle that. The Smurfit Stone acquisition caused Rock-Tenn to increase its shares by a substantial amount, 79%, and they also incurred a lot of debt. Currently, their goal is to reduce their leverage by about 1/3 by the end of fiscal year 2014. So we don't expect any significant acquisitions to occur within the next several years. They're slightly more leveraged than they were prior to the acquisition, with a debt equity ratio of about 2.13 now as compared to 1.87 prior to the acquisition. Additionally, with a TIE ratio of slightly above 4, we agree with management in their concern of trying to eliminate at least some of this debt before they advance with any future capital expenditures.
Right. Well, so if they're having to redeploy their all their cash flow to paying down debt, what does that mean for me as a shareholder? It seems to me that that's going to impair their ability to increase their dividend, reduces their financial flexibility.
Yeah, well, you make a good point there. The Smurfit Stone acquisition did reduce their financial flexibility. When we listened to the conference call, they said that one of the things they want to do with their dividend, which is a 1.2% yield of 90 cents a share per year, is that they don't want the dividend to discourage investment, but they don't want it to be the sole reason you invest in the company. Again, they think that by the end of, they're going to pay down this pension, and by then they might be able to, they have less leverage, they might be able to fund other acquisitions, but and maybe share repurchases and increased dividend. But until then, it's not really an issue because their acquisitions thus far, we believe management has proven they have made good decisions with their acquisitions, and they have really helped their core business.
And in addition to that, share repurchasing, they haven't really engaged in that significant of share repurchasing, which, as a shareholder you might want. But they said that after they get their leverage down, and they'll begin to repurchase some shares, and they're not planning on acquiring any more companies within the next few years. So we're hoping to see that they use some of that extra money once they pay down their debt some to engage in some share repurchasing activity.
Do they hedge any of their energy costs?
No, they don't. And, within the containerboard industry, it's so consolidated at this point that that they're able to pass on any increase in the input cost onto customers in terms of increasing the prices of their products. And if they were to hedge and guessed wrong, and others in the industry did not do the same thing, then they wouldn't be able to pass on those costs to the customers because they would be the only ones to have done it.
Have any of you been around a paper mill?
No, sir.
They stink like crazy.
Thank you.
We've got a very active EPA. How regulated is their work, and is there any worry that you might have
Well, in the
concerning their cost and having to meet the regulation and shutting down those stinky paper plants?
Well, in the past years, there has been an increasing amount of regulations and laws regarding the environment and kind of disposal and storage of waste products and emissions. And the current regulations under review, they don't appear that they'll have any greater effect on Rock-Tenn's business than it would on a competitor. And there's a Boiler Act, which is talking about, I guess, their certain machines they use in their paper mills, and Rock-Tenn said that they don't have that many of them, so it won't impact them that much. It's still under review, so they don't know if there's anything further with that. And they've done a good job of implementing changes to reduce their carbon emissions by as much as possible, and now in the future, we don't know if the standards will become stricter and they'll have to invest more in that, but it won't really impact them more than another competitor, I guess.
I think you had done some work based on valuation, on historical valuations, last 4 or 5 years, for those actual numbers you were using?
For the...
Rock-Tenn for your valuation, I think discounted cash flow or whatever it was, trailing 5 years?
Yeah, we used the trailing 12 months as well as forecasting.
So you just used the trailing 12 months for your forecast after the Smurfit?
After the Stone.
Okay. What was the original price when you put this on?
$89.
No,
Oh, that's
Oh,
correct.
oh, $76.
72.
it was 72. Let's say I
72.
took your advice and I bought it at 72. Today it's at what, 86, 87?
It was $6.50 last night.
What should I do?
Well, as
I
of
mean,
right
what if I
now,
don't trust you a whole lot? Should I sell? Or should I keep that thing and buy some more?
we recommend that you continue to buy some more.
And how much of my portfolio should I own in it?
Well, I don't know about you, but actually.
How
this-
much does this industry represent in the S&P 500, do you know?
In fact, last week at Walker, we have a student-run investment portfolio.
Mhm.
And last week, we actually purchased it to represent 4% of our total holdings.
Did you buy it earlier at 72?
No, sir, we did not. We did buy it last week.
It was the first meeting.
Hey, I like your hair too, by the way. I mean, it's, you know, higher. That's good.
Thank you.
So you're telling me I should buy more today or just hang on to what I have?
You should buy more, because we think that it definitely.
And what price should I sell it at?
That's what reaches our price target.
Your price target.
Yes, sir, which would be $103.
Okay.
How much of the synergies of the acquisition were they projecting, and how much have they already incorporated?
They're projecting $550 million. They have done $300 million thus far as of the end of first quarter 2013. But actually, in our analysis, we only, I guess, included 475. So we have conservative numbers built in. So we're actually planning on them not to realize all 550.
Well, conservative relative to management.
Right. Yes. Conservative based on what they said they want to do.
Management said they were going to realize that over what period when they first did the acquisition?
when they first did it, they said they would realize it by the end of 2014. And now they've extended that to the end of 2015.
And in addition to that, I mean, Rockton, the way they've grown in the past has been through acquisitions, and they've been really successful at integrating them, and have in the past 3 exceeded their estimated amount in synergies. And I think with the Smurfit Stain acquisition, it's the largest acquisition they've ever done. And so, in our minds, we think that Rockton's management might have been a bit naive in assuming that they could get Smurfit Stain operations up and running and more as efficient up to Rockton standards in that amount of time. So it's taken a little longer than expected, but after a couple initial setbacks, they've replaced management in certain areas, and they've gotten back on track to what they originally said they would be at this point.
Because they even said in one of their earnings calls that for the longest time they kind of trusted that Smurfit Stone managers could continue to run their operations, but recently they've decided that no, we're going to replace all that with Rock-10 managers, and they've since become more efficient.
You mentioned something about pension obligation.
Yes, sir.
Is there, how much is it?
1.2 billion.
It's $1.2
That's the
billion.
unfunded portion?
Underfunded.
What's the net equity in this company?
That unfunded, or is that the total liability?
That's the liability.
That's the total liability.
And
what the
What are
unfunded
the
portion?
assets in the pension?
I mean, they're paying $200 million a year in the pension, but that's also offset by tax credits and also amortization.
Well, that's not-
They're contributing to the pension, or those are the...
That's what they're going to contribute to the pension. Yes, sir.
So that's 1.4. Well, they're underfunded.
Yeah, right.
That's what you just
They
said.
got liability that big.
But that's why, and how much is the equity in the company? I mean, as far as a shareholder, how much of that company do I own? How much is the net worth of the company?
The market cap's a little under 6
Not the
billion.
market cap, I'm talking about the book value of the company, the underlying equity assets in the company itself. Do you have any idea? What's the book value? And how many shares are outstanding?
72 million diluted EPS.
Well, what I'm getting at is if we got an unfunded liability in a pension plan of $1.5 billion, or if that's just the
Well, I think
total
that's-
liability, but I don't know, so I'm asking them. And we got a net worth of $1 billion. What do we own? An unfunded liability? One last thing, and I'm sorry, I'll get off this. You said this is a consolidating industry. Is anybody big enough to buy this company?
Okay, the only company big enough to buy Rock-10 would be IP. However, we don't really think IP is going to come in and buy Rock-10 and have a greater presence in the corrugated segment, because we really think antitrust issues are going to arise.
What about globally?
Globally, we don't think international competition. You're asking about international competition? We don't.
Not competition, acquirer.
An acquirer. We really don't think this is going to
It's time.
Are we allowed to?
Yeah.
Yeah, okay.
Appreciate it.